let's shift gears for a second to the conversation about quantitative easing to rolling off in the summer. And I had a brief conversation with your colleague, Mohammed El-Arian, and we talked a little bit about the sort of bifurcation in the marketplace between what the economists of the system are worrying about and thinking about with regard to the overall stock of bonds in the marketplace versus what I gather PIMCO is looking at and thinking a lot about in terms of, well, what are the flows in and out of bonds going to be? And that's a little opaque perhaps, but maybe you can help straighten out and explain to our subscribers what you're thinking about.
Well, let me put it simply, because I'm a simple guy and I look at these simple metaphors. Hopefully this one makes some sense. I mean, the flow argument is basically our question as to who will buy them. Now, the stock argument is an argument that the Fed endorses, and look at it in these terms. The Fed basically says, listen, we've been buying Treasuries for the past 2 years, and it's sort of like, if, at home, if you had a cupboard of cereals, and let's call it Rice Krispies. The Fed basically says, hey, we've bought all the Rice Krispies for the past 2 years, and so your stock, PIMCO, or your stock, Mr. or Ms. Bond Manager, must be low on Rice Krispies. You've eaten through your Rice Krispies over the past 2 years because we bought all the new ones. And so they basically say, so when QE2 ends, from a stock standpoint, from what's in that cupboard,
the stock of Treasury bonds,
the stock of Treasuries, you've got to go buy some Rice Krispies, and so it won't be a problem after June 30th because investors don't have enough of what they should have. PIMCO basically says that's probably correct from the standpoint of a metaphor, if indeed that's your metaphor, Mr. Bernanke, but we don't necessarily have to restock with Rice Krispies. We could buy some Frosted Flakes, or we could buy some Raisin Bran, and that metaphor basically says we can buy mortgages, corporates, we can buy German bunds. We don't have to buy overvalued U.S. Treasuries and stock up with what you consider to be a necessary portion of Rice Krispies. Did that help?
Yeah, absolutely. And the follow-on, I think, to that, and tell me if I'm misunderstanding, though, is that even though you're not pounding the table today trying to say, I'm not buying Treasuries because they're going to default, I'm not saying that the U.S. government is on the brink of disaster, but in talking to you and Mohammed, I do have the sense that you, as a group, PIMCO feels that the world at large is starting to at least think in terms of credit quality for U.S. debt, and that part of that argument about buying other kinds of cereal in the metaphor is that, hey, Canada, Australia, there are other places we can go where we're more comfortable with the credit as well.
Right. There are, in Mohammed's terms, there are cleaner, dirty shirts. Canada has half the debt that we have relative to GDP. Germany has less debt to GDP and stronger growth prospects. So there are countries that have better prospects from the standpoint of future debt to GDP. I'm going to start out the conference in a few minutes with a headline from USA Today. Yesterday, you probably saw it. It basically said $65 trillion worth of debt for the United States. And by the way, that's an understatement. So sooner or later, and that of course becomes the problem for investing, whether it's in bonds or stocks or real estate or commodities, it's whether it's sooner or later, but certainly later, the United States has a significant problem in terms of debt and deficits, and it has to be corrected immediately, though, in terms of a debt ceiling and debt limits and the progress that hopefully will be made towards those goals. We don't see it as a problem of default, certainly. Moody's or Standard & Poor's might downgrade the prospects, but this is not a credit problem in the immediate future for the United States, but certainly on a longer-term basis.